In the 14th century, the ocean was not a highway, it was a graveyard. For the merchants of Venice, Genoa, and Pisa, the sea was the ultimate predator, a silent partner that took its share not in taxes, but in blood and wood. To launch a ship was to commit an act of desperate speculation. You were loading your entire life's work, your family's reputation, and the future of your guild onto a fragile shell of oak and hemp, then tossing it into an abyss that recognized no king and respected no law. One storm, one pirate raid, or one navigational error did not just mean a delay, it meant total liquidation. It meant the sudden, violent erasure of capital. In the medieval world, if your ship sank, your house was repossessed and your name was struck from the ledger of history. But humans have a unique talent. We learn to price the chaos. This is the story of how the Western world stopped praying for calm seas and started hedging against the storm. It's about the birth of insurance, the invisible shield that allowed the Renaissance to be built on the ruins of shipwrecks, and how European merchants turned the unpredictability of God into the mathematics of the market. To understand the invention of insurance, you must first understand the terror of the total loss. In the early Middle Ages, trade was a lonely, daring venture. If you were a merchant in the year 1200, you traveled with your goods. You were the investor, the captain, and the defender. If the ship went down, you went down with it. There was no separation between the person and the profit. The first crack in this wall of risk appeared with the Commenda. The Commenda was the beta version of the modern corporation. It allowed a sleeping partner, usually a wealthy noble or an elderly merchant, to stay on the docks while a younger, hungrier traveler took the risk at sea. The investor provided the capital, the traveler provided the labor. If the ship returned, the investor took the lion's share, usually 75%. But if the ship was lost, the investor lost his gold, and the traveler lost nothing but his time. It was the first time in history that capital and risk were separated. But it wasn't enough. The Commenda was still a binary venture, all or nothing. It didn't protect the merchant from the systemic collapse of his entire fleet. He needed something more sophisticated. He needed a way to turn risk into a premium. But there was a shadow looming over this financial evolution: the church. In the eyes of the medieval church, charging money for time, what we call interest, was the mortal sin of usury. To the bishops of Rome, time belonged to God alone. To profit from the passage of time without physical labor was to steal from the Almighty. This created a massive roadblock for the financial world. You couldn't simply lend money to a merchant and charge interest to cover the risk of his ship sinking. That was a ticket to hell. So, the merchants of the Mediterranean became masters of the loophole. They practiced a form of financial alchemy. They created the maritime loan, or thanis nauticum. Here was the trick. The lender would give the merchant a large sum of gold before the voyage. If the ship returned safely, the merchant paid back the loan plus a gift, a massive surcharge of 20 or 30%. However, and this is the crucial part, if the ship was lost at sea, the merchant owed nothing. Legally, this wasn't a loan with interest. It was a contingent arrangement. The lender was projecting that the ship would survive. Because the lender stood to lose everything if the ship sank, the church allowed the high surcharge as a reward for peril rather than profit from time. By the year 1300, the counting houses of Genoa and Florence were no longer just places where money was exchanged. They had become the world's first laboratories of probability. The bankers began to realize that if they backed 100 ships, they didn't need all of them to survive. They only needed a certain percentage to make it home, to stay solvent. They began to track the weather, the patterns of pirates, and the structural integrity of hulls. They were becoming the first actuaries of the abyss. But as the trade grew, the maritime loan became too clunky. It required the physical movement of gold before the ship even left. The merchants needed a way to protect their goods without actually borrowing money. They needed a promise of indemnity. In the 14th century, the world's first independent insurance policies were born. For the first time, a merchant would pay a small, non-refundable fee, a premium, to a third party. In exchange, that third party signed a document promising to pay the full value of the cargo if the sea claimed it. The underwriters had arrived. These men would subscribe their names at the bottom of the contract, indicating how much of the risk they were willing to take. This is where we get the term underwriter. In Antwerp and Amsterdam, insurance evolved from individual pledges into a standardized system. The Dutch realized that if you could insure a ship, you could insure an empire. They integrated insurance with the first joint stock companies, creating a financial armor that allowed the Dutch East India Company to dominate the spice trade. By the late 17th century, the protection against the sea had moved from the stone tables of Genoa to the hazy, high-energy back rooms of London. The maritime world was becoming a global machine of empire, and every machine needs a central nervous system. In a small coffee house on Tower Street, owned by a man named Edward Lloyd, the future of global finance was being written. Lloyd's wasn't a bank, it was an information exchange. It was a place where risk was stripped naked and analyzed. The underwriters at Lloyd's were no longer just relying on luck, they were relying on data. They developed the world's first standardized shipping registry, Lloyd's Registry. They graded ships from A to E based on the quality of their hull and equipment. This is where we get the term A1, the gold standard of reliability. The insurance market was doing what no government or navy could do. It was forcing the world to build better, safer ships. Because in the cold logic of the ledger, a shipwreck was no longer a tragedy, it was an unacceptable expense. But as the system became more sophisticated, it birthed a new predatory underbelly. The invisible shield of insurance had created a dangerous phenomenon: moral hazard. When a ship is worth more at the bottom of the ocean than it is at the dock, the sea is no longer the merchant's enemy, it becomes his business partner. In the 18th and 19th centuries, the coffin ship became a terrifying reality. Unscrupulous owners would insure a rotting vessel for 10 times its value and send a crew out into a storm, praying they would never return. If the ship vanished, the owner became a millionaire. If the crew drowned, they were simply collateral damage. The underwriters fought back. They hired marine surveyors, the first private detectives of the sea, to inspect every plank. They created the Black Book, a list of owners who were never to be insured. The battle against fraud turned the insurance industry into a private intelligence agency, with eyes in every port from Kingston to Calcutta. Despite this dark side, insurance was the silent engine of the age of discovery. History books tell us of the courage of explorers, but they rarely mention their indemnity. No rational investor would have funded a voyage to the edge of the known world if a single storm could wipe out their entire fortune. Insurance allowed capital to be bold. It allowed wealth to be decentralized. You didn't need to be a king or a pope to fund a voyage. You just needed a syndicate of underwriters to spread the risk. This led to the creation of the joint stock company, the ancestor of every modern corporation. If insurance protected the ship, the stock market protected the company. Together, they created a financial superpower that allowed tiny islands like England to dominate the globe. They didn't win through superior steel alone. They won because they had a superior way to handle failure. The medieval arrangement against the sea didn't stay at sea. If you could insure a ship, why not a house against fire? Why not a life against an early death? The Alchemy of Risk had transformed the nature of human existence. We stopped seeing the future as a series of divine punishments and started seeing it as a series of probabilities that could be managed. Today, we live in a world built on the foundation of those medieval arrangements. Every time you drive a car or start a business, you are participating in a system that began with a terrified merchant in a 14th century port. The ocean remains as merciless as ever, but we no longer tremble before the storm. We have built a world where trust is quantified in premiums and sovereignty is backed by solvency. The merchants of Venice and the coffee-goers of Lloyd's proved that the greatest weapon against chaos is not a sword, but a contract. They taught us that while we cannot control the wind, we can always insure the sails. I'm Gavin, and this is Medieval Echoes. Subscribe to break the cycle, because history doesn't just repeat, it rhymes. If you know the pattern, you own the future.